Good afternoon, everyone. Ron Bullis here. If you're new to one of our client live streams, welcome. I'm one of the co-founders and CEO of Lifeworks. We're still a few minutes out from 3 p.m. Eastern when we are scheduled to kick off, but I just wanted to turn my mic on real quick. For those of you that have never been on one of our live streams before, welcome. This is also a unique space. If you look at the bottom of your screen, if you're on a laptop, iPad, or desktop, you should see some menu buttons. One of those that exists there is a little call out chat icon. If you click on that, you'll be able to ask me questions and engage with some of our advisors who will be on this live stream today. Right next to that, just to the left, you should see a little smiley face. You will find Giphies, emojis, and reactions in there. If you can hear my voice okay, go ahead and give me something fun. Keep it PG. Perfect. Awesome. I see some people that have been clients of Lifeworks quite a while. Really great to see you here. And looking forward to today's webinar. I'm going to turn my mic back off for the next couple minutes while I'm enjoying my afternoon Dandy Blend coffee substitute, which is healthy, by the way, and no caffeine. And we'll get started here in just a couple more minutes. All right, let's get started. Anybody who's still jumping in will find their way here. Let's do this. There we go. Okay. Welcome, everybody, from Grand Rapids, Michigan, where winter has officially arrived. It's a balmy 30 degrees outside. At least we have the sun today. I hope you are somewhere warmer and where the sunshine is shining. I've got a interesting webinar in store for us today. It's not maybe going to be some of my typical webinars where I'm taking you guys through slide decks where we have graphs about what's going on in the market. In fact, apologize in advance if anybody thinks this is going to be a webinar specifically on the market, what's going on, or economic stuff. I'm happy to talk about anything in Q&A, but I'm not planning on going through the market. Today's webinar was specifically designed to talk about in detail some of the unique aspects of the Lifeworks investment platform, and then some really important updates that are happening right now that if you haven't already started talking to your advisor about, it's very likely in the next couple of weeks or coming months, you're going to hear from your advisor about a new custodian that we put in place that we actually believe is going to be the best custodian for our clients, for you going forward. We're going to talk about direct indexing. It's something that maybe you've heard about, maybe you've seen some stuff about. We're going to talk about why Lifeworks uses it and why we're going to start using it even more. We're going to cover tax loss harvesting. What is it? What is some of the software that we've put in place to start doing this in an even more robust and automated way for our clients? And we're also going to talk about one of my favorite subjects, the protected portfolio and downside protection. I've had that question come up a lot from advisors through their clients. It happens to be one that seems to, no matter what the market conditions are, people want to have a conversation about that. So before I get started today, I'd love to just take 60 seconds, 3 minutes, something like that. If you have a topic, question, concern about Lifeworks, the market, the economy, type it into the chat real quick. Again, if you're on our live stream for the first time, if you look at the bottom of your screen, if you're on a laptop, iPad, or desktop, you will see a menu. There's a little call out icon where there's a chat feature. I have your mics turned off for now. I'll turn them on towards the end of our live stream today where you can actually ask questions. We can go back and forth this way, but just for efficiency in the beginning, I have them turned off. But let's take 60 seconds, maybe 3 minutes. I'll try and fill the dead space a little bit. And if there's a question, comment, topic, or concern about the market or something you'd like to know more about Lifeworks, go ahead and throw it in the chat. And I'd love to make sure we cover that in our time together today. And if you're wondering, we also do have a handful of our team that is also on this, that are advisors as well. And so there'll be a few other people answering. I'm just seeing who all is here right now. There'll be a few other people answering your questions as we go as well. It won't just be myself, although I will do my best to try and answer questions while they're coming at me. You're absolutely welcome, Bernie and Vicky. If we had more time and if my 4 kids and travel, soccer, and busyness as the CEO of Lifeworks permitted, we'd love to do one of these every day. We love engaging with our clients. So we try and have these at least once a month. In 2026, we're going to be picking up that pace and doing 2 of these a month. So happy to do that. Okay, let's get kicked off today. I'm expecting to talk a lot, so I've got my water and I've got my Dandelion caffeine-free afternoon coffee substitute here. It's actually pretty good, but maybe I've just gotten used to it. So what we're going to do to kick it off, I don't want to assume that every client of Lifeworks knows everything about the Lifeworks platform, because it's likely that even if you've been a client for a while, you might not have used all the resources, or it might not have been applicable to you at the time. But I think it would be really helpful. We've heard from a number of our advisors who've had new clients say, I'd love to just have a better picture of the Lifeworks investment platform. And so over the last couple of months, I've been walking through the Lifeworks investment philosophy, why we use factors as opposed to active management, why we're not a passive investing shop, why we're certainly not using technicals or charting or whatever other wizardry people claim to be able to predict the market outcomes with. And then the following month, I talked about our life-driven investing, why we use your financial plan and your cash flow needs to build a custom portfolio that's the right thing for you. If you didn't get a chance to watch those, I'm not going to cover those 2 topics, which are very important, our investment methodology and our asset allocation or portfolio construction. I'll have somebody on my team put those links to those videos. They're out on YouTube where you can go back and watch those if you're new. But I'm going to try and do as good of a job as I can covering an overview of the Lifeworks investment platform, and then specifically some new stuff that's coming for those of you that have been clients for a while. We have a new custodian that we're really excited about, and I'm going to talk about that. Okay, I do see a question from Jeff about explaining diversification in the Lifeworks framework. Ooh, that's a really good one. So I will tackle that as well. So if you're just jumping on as we're going, again, my name is Ron Bullis, one of the founders and the CEO of Lifeworks. Feel free to throw questions at me as I'm presenting. It's going to be a little bit less formal of a presentation today, as I am planning on just sharing some screens. I also have my iPad here. I'm going to draw a few examples and walk you guys through that. So feel free to throw the proverbial brick at me by asking me a question while I'm going. Don't hesitate. There's no such thing as a dumb question, unless you're somebody on the Lifeworks team, and you should know it. Just kidding. All right, so let's cover a couple things. One of the things I want to talk about first is our custodians. So what is the role of a custodian, and how does that relate to Lifeworks as a registered investment advisor and you as the client? So Lifeworks, and I apologize if this is rudimentary, but I just want to start here so everybody has the same kind of base framework and we can work up from there. Lifeworks is what's known as a registered investment advisor with the Securities and Exchange Commission, the SEC. Now, an RIA is not a broker-dealer, so we don't sell products. We don't make commissions. We're not a bank, right? What we are is we are a regulated body that's required by law to operate as fiduciaries for all of our clients. Our industry uses that term, unfortunately, very loosely, and there's a lot of advisors and a lot of financial professionals at different types of firms that do sell products, that do have broker-dealers, that do make commissions. Our belief on that is that there are a lot of phenomenal advisors out there, but it's really hard to always truthfully put your client's best interests first when you have to sell proprietary products, you have to sell products for commissions, or you're inside of a large, let's say, mega corporation that basically says, do this and don't do this for your client. So we are an independent investment advisor for our clients, operating as a fiduciary at all times, okay? Now, I start there by saying that because as an RIA, registered investment advisor, we use custodians, and just like the name sounds, custody, who hold our clients' accounts and our clients' assets for the benefit of our clients. Now, it's important that there's a custodian in our relationship. Right next to the chat call out, you'll see a smiley face. Give me thumbs up or some kind of funny emoji or Giphy if you've ever heard of Bernie Madoff or what happened with Bernie Madoff's investment company. Okay, a few of you. It's an interesting story, one to potentially Google. Bernie Madoff was a well-regarded Wall Street insider that ran a very large investment firm, talking billions and billions of dollars. He went to prison a few years back because it turned out to be a Ponzi scheme. Ooh, I like the little French, I think that's a French bulldog. I like that, John. His firm, and I'm not saying anything derogatory about him as an individual, but what I think he stole billions of dollars from people, so he deserves to be in prison. But the point I want to make here is that he was not using a custodian. He was actually taking custody of his client's assets, which some firms are allowed to do, right? And he was the one issuing statements to his clients. So when his client said, "Where is my money and how is it performing?" it was actually his firm that was issuing the statements, right, to attest to how much of their client's money was there. And essentially it was a Ponzi scheme. He absconded with a lot of it. Why do I say that? Lifeworks intentionally, when we set up our firm, wanted to have in place safeguards for our clients' assets because we believe in being a fiduciary. Now, does that mean that our custodians that we use are perfect, that there's no financial risk to custodians? Absolutely not. They're considered to be extremely safe, though, so nobody panic, your money's fine. But what it means is you can go to the custodian and we can go to the custodian and we can see your account verified by an independent third-party custodian whose entire job is record keeping and safekeeping. Okay? So I wanted to, again, we're a registered investment advisor. We operate as a fiduciary at all times. We use third-party independent custodians to safeguard our clients' assets. Everybody tracking with me so far? Sorry, this I promise will be the most boring part of my presentation today. Okay. I love the reactions to you guys. Somebody just gave me a Bernie Sanders one, and I've got a French bulldog. This is great. Okay. So Lifeworks right now has for the last couple of years had two primary custodians. Charles Schwab and Company, which is one of the largest financial institutions in the world, and then a custodian that most people have never heard of called Apex Clearing Corporation. And Apex is a very modern, technologically forward custodian that's essentially was the engine behind a lot of the very well-known, what we call financial technologies or fintechs that have come to market in the last 10 years. And Apex did a lot of very interesting things that Lifeworks wanted for our clients and we built towards. So about half of our clients are on each custodian, depending on what's right for them. But we're adding what we believe is going to be the best custodian for our clients going forward, and it's a company called Altruist. Altruist was founded by an individual by the name of Jason Wenck, just happens to have also come from the West Michigan area, although that's not why we chose them. But Jason built a very successful wealth management firm, sold it, and then he subsequently went and started a custodian to try and fix some of the problems that he had with when he was a wealth management firm with the traditional custodians. So they wanted to solve for things like very simple and easy online account opening, fractional shares, which I'm going to talk about, why that's important, what they are, 24/7 automated tax loss harvesting, direct indexing, and a whole bunch of other things. So Altruist, which we'll be sending out more in the coming weeks, is a firm that Lifeworks has known for some time now. We've been engaged with their leadership team, having discussions. And in Q3 of this year, we adopted them as a custodian. We're really excited about the capabilities and the opportunities that they provide our clients. So first update to the Lifeworks platform for you is that we are adding a new custodian to our existing custodians. What this means for you as a client is that Lifeworks is still always going to do what's in your best interest, And when we go through the work, which it's a lot of work to add a new custodian partner, integrate our software with theirs, get everything set up from a legal perspective, that's a lot of groundwork that happens behind the scenes that our leadership team and operations team works on. But we're doing it because we believe it's the right thing for our clients. So what I'm going to do is I'm going to shift into talking about some of the things that Altruist does that we believe are very beneficial for our clients or will be beneficial for you, okay? I'm not in any way going to disparage any of the other custodians or talk about other financial firms in a negative light, but I am going to contrast some of the things that Altruist does very uniquely that are very differentiated from the traditional custodians. So please don't anybody mishear me. This isn't going to be Ron's beating up on, Chase as a big bank or Schwab or Fidelity or something like that. I'm just going to make some compare and contrasts because there's a place for both custodians in the future, okay? Oh, Jeff, woohoo for Altruist. I like it. And I will get to your question, Jeff, about diversification. Okay, I'm going to share my screen here a second, and I'm going to just do a compare and contrast. Feel free to ask me questions as I am going through this. Okay, one of the challenges that we've heard from our clients, and we feel it, give me some kind of funny reaction. If you've ever gone to the bank, asked for a mortgage or a loan, and they said, yes, it'll be 6, 7, 8%. But then when you open a high yield savings account, they're like, congratulations, Mr. Bullis, we're paying 0.25% interest on your cash savings. Now, I use a credit union that pays a little bit higher interest rates, but how many of you guys have been through something like that before? I can't be the only one. Yeah, I know. Oh, that's a good one. Thumbs down. Jimmy Kimmel, love it. Now, this is right from Charles Schwab's website. And again, they're a custodian. We think very highly of them. They're a very large institution. And one of the challenges that we've had, and this is going to end up tying to a couple of other things. So just like kind of lodge this in your head. And then I'm going to connect the dots as I go through my presentation today. One of the challenges that we have is this right here, uninvested cash in your Schwab brokerage account is paying 0.05%. My finance professor would have said this is 0.0 nothing, just as a joke. Okay. Now, we have to hold a little bit of cash for our clients, for you, in your brokerage, in your investment accounts. Well, why? Well, a couple of reasons. One, because we have to pay the investment fees for managing your account. That would be one reason. But another reason is because at the traditional custodians, we have to purchase whole shares. Meaning, if we want to buy these 50 stocks, right? So following our factor investing methodology, which I covered 2 videos ago, like we say, look, these are the 50 equities in the S&P 500 that we believe represent the best value, the highest dividend paying rate, et cetera, and we want to buy these 50 equities. Well, I have to buy a whole share. I don't get to buy a fraction of a share. And because stock prices are also quoted in decimal points, right? And because they never have just perfectly round values like $5, $10, $20, $100, they're things like $370.17, right? What we wind up with when we are buying and rebalancing and managing clients' assets is rounding up and rounding down amounts of cash. So it's never perfect, okay? Well, when we have to buy whole shares and we have a little bit of residual cash left over, now what we're doing at Lifeworks with it is not just cash account, we're also using money market ETFs and things that invest in interest-bearing securities, but just in general, what happens is there's this inefficiency there, right? You have $1 million portfolio, but maybe we can only invest $999,500 of it because there's a rounding error when we're buying equities. So Schwab, for our clients, is paying 0.05% on uninvested cash. And if we open an investor checking account for them, they're paying the same thing. Now, just as a kind of point of reference, This is Chase. Again, I'm not speaking poorly of them. I'm just going to plug in the Grand Rapids zip code here. And on their savings interest rates, they're paying 0.0 nothing as well. All of us live in this world. Now, I use a local credit union called Lake Michigan Credit Union. They do a fantastic job. I thought Chase did a fantastic job, by the way, as my bank. So again, just showing what's on their site. And when we look at this, okay, it's like, oh, maybe the credit unions are paying a little bit higher, annual percentage yield. But most of them are paying 0.0 nothing. So what happens? Well, we recommended to our clients over the years that we would use things like the American Express high yield savings account or Flourish or different high yield savings accounts that would exist out there, right? In an attempt to try and help you have a return on your cash that's something better than 0.0 nothing. We know that it's likely on the best day, our cash is just going to keep pace with inflation. But in the last couple of years where inflation has been, government stated inflation, 6, 7, 8%, maybe real world inflation for those of you that have to feed yourselves and feed kids at home like I do. It's like price of eggs, price of beef, price of like everything we buy at the grocery store is up significantly. So in the best case scenario, we're trying to help our clients, you guys, find places where we can have cash because we need cash to pay the bills, right? Where we're at least keeping pace with inflation. But the challenges that this presents, most of you guys are aware of this, right? Like we're helping you manage your money here. And maybe if you're in retirement, we're making distributions to you. And then you have a checking account somewhere and you're using that to pay the bills. Then we have some excess cash, right? That's going to cover the rest of that year's distributions. And so that's sitting over here at a high yield savings account. And we just have multiple things going on at once that creates complexity. Well, Altruist, which is our newest custodian, is paying almost 3.5% on our clients' cash. Now, we have no financial interest in Altruist. They are completely independent of us. We don't make any commissions from them. I wish I maybe had some shares in the company because I think they're going to be a phenomenal, large financial institution down the road, but they're paying our clients a really reasonable rate of return on their cash. And it's FDIC insured up to $3 million for individual accounts and $6 million on joint accounts. Now, what we like about this, and it's one of the reasons why we've selected Altruist to be one of our primary custodians for our clients, is now when we have cash sitting in your account, even if it's a small amount, it's earning a higher yield. We also have the ability to open essentially a cash account, a bank account for you at our custodian, where we can help earn a rate of return on your cash that's better than 0.0 nothing. And it's integrated. So our team's been testing this, but I opened an account for my wife and I, transferred in some cash from our credit union, transferred some cash back to the credit union. It's generally same day or next day. Very efficient, very fast. This is just a small little thing that what I want everybody to hear is our team and I obsess about how do we get the most for our clients? Like, how do we drive better outcomes? As our industry would say, we're fiduciaries. I actually use the term internally. One of our core values at Lifeworks is the word stewardship. And not just from a religious perspective, like that word gets used a lot there, but truly in the sense that when we get really honest and really clear about what our role is, it's actually not about us and it's not our money. It's about you, our client, and the life that you guys want to live, and it's your money. And we take that really, really seriously. So if we can do a bunch of legwork behind the scenes and spend hundreds of hours setting things up and lots of money on attorneys, like, even though that doesn't appear anywhere as a financial benefit for us, we do that type of work because it's the right thing for you. So if you're at Schwab, don't mishear me, like you're more than welcome to keep your accounts there, but there's likely a really great conversation to have with your advisor about Altruist as our custodian and what they do, okay? Now, Altruist does some other things that are very interesting And one of them is fractional shares. Before I move on, does anybody have any questions about that? So we are an SEC registered investment advisor operating as a fiduciary. We use custodians to safeguard our clients' money and provide a third party verification that your funds are there. We can't Bernie Madoff any of your money. And Altruist has high yield cash accounts, savings accounts that are paying like 20 times what most of the major banks and firms are. Everybody, like, that should be pretty straightforward, but thumbs up, give me a Giphy or a reaction. Everybody's tracking with me. I was a little worried today's presentation might feel a little bit dry, but hopefully this is helpful to set the stage for how our leadership team and our advisors obsess about things like this. Okay. So Thad has a great question. The $3 million FDIC insurance applies to cash, and it applies specifically to cash in their high yield bank account on their platform. Okay. Investable assets inside of an investment account are protected by what's called the Securities Protection Insurance Company, SIPC, right? And there's different limits on that. But unlike a bank that's commingling your money with everybody else's money and then making loans, the custodian is actually holding those assets in a custodial account separate from everybody else and just for you. So there's not a space where Altruist is going out there and making loans to people and creating financial instruments and putting your investment account at risk. Okay, that's a really important distinction. Great question. Jeff, do we need to go through our advisor to withdraw money from Altruist? No. I thought about just sharing it, but it would probably be a little awkward. But they have a native mobile app for both Android and iPhones. And they also have a really easy to use web app. 24/7, you can go in there, push a button, move money in and out of your cash accounts. And you can also move money in and out of your investment accounts. Now, little caveat here. Maybe before you move money out of your investment account, if it's going to trigger a sale or something like that, that might have some tax ramifications to it. Definitely give your advisor here a heads up and just have a quick conversation. But in terms of, let's just run through a very normal scenario, right? Client has $2 million invested with us, saved for retirement, and they need to spend $60,000 a year from that account to cover their retirement expenses. The way LifeWorks allocates money, so Jeff, I'll maybe talk about diversification here, is we match the right type of investment asset that has the right liquidity and volatility characteristics with when you need to spend the money. So the $60,000 in this hypothetical example that Mr. and Mrs. Smith need to spend this year to pay the bills, well, that $60,000 we believe should be sitting in a high yield checking savings account of some kind. It should be very liquid, have no fees to it, be easily accessible, very boring, right? But extremely important, because we wouldn't think it wise to have the money you need to buy groceries and pay the bills and pay your Medicare premiums or whatever at risk in the stock market, right? So the closer in time to when we have to spend the money, the more liquid we want it and the safer we want it. Now, if we don't need to spend the money for 10 plus years into the future, well, then we believe those assets should be more focused on growth to combat inflation. I mentioned this on our last video. The real enemy that all of us face as people that are either saving or investing towards a goal, or people that are near retirement or in retirement and getting ready to spend their money, the real enemy isn't the market going up and down. The real enemy is that everything you need to live on is going to cost you more every year for the rest of your life. That's actually by definition what inflation is. Everything that you need to live on is going to cost you more every year for the rest of your life. So if a dozen eggs today costs $8 or whatever it is now, $10, right? If it stays on that trajectory, it might cost $20 in 10 years. So we need to have money invested in assets that we believe are going to generate a rate of return above inflation to protect your purchasing power and to provide the ability for you to achieve whatever the goals are, whatever the life goals are that you have for you and your family, right? That I'll get to your question about checking account, can talk about that. So how do we handle diversification? Well, first and foremost, LifeWorks believes that you should be diversified not between stocks and bonds and real estate and small cap and mid cap and large cap and like all of that conversation. There's a technical conversation to have there, but that's not our definition of diversification. Diversification for us is making sure that we, with foresight and strategy, allocate the right amount of money in your portfolio to the right type of asset for when it needs to be spent. So you could think about it in a simple, like 3 tranches or 3 segments of your investments. Tranche number 1 or segment number 1 is what we call the safe assets. And that's the next 3 years of what you need to spend. Tranche number 2 is year 4 through year 10. And those things should be things like low volatility stocks, hedge equities. The last couple of years, we started using fixed income again. As interest rates went up really, really rapidly, bonds and US treasuries and T-bills started paying positive rates of return. And then the last segment of your money is money that you don't need to spend for 10 plus years into the future. So if you're 63, these would be dollars that you're not planning on spending until you're 73 or older. Those assets, we believe, should be invested in growth assets, stocks, real estate, gold, Bitcoin, things we typically hold for our clients in their portfolio. So our definition of diversification isn't what the industry generally talks about diversification, which is like how much do you have in emerging markets and how much do you have in US and how much do you have in large cap and small cap and blah, 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 blah. The reality is most all risk assets, everyone, real estate, equities, emerging equities, small cap, mid cap, large cap, most all of the things that are at risk in the market become very highly correlated during periods of market uncertainty or volatility. Meaning, if we own a stock that's an international stock and the US stock market takes a dive, it's likely that that international equity is taking a dive too. There's this joke that somebody sneezes in China, we catch a cold here in the US the next day, and then Europe's sick with the flu the next week. Like it happens truly even faster than that. So that's diversification. Yeah, do they offer a checking account option from the cash? That is a really good question. I haven't written a check in a long time. And so when I opened my cash accounts, I was more focused on electronic contributions and distributions. I think there might be check writing capabilities on the accounts, but I'm not sure. I'll tell Chris to check into that and get back with you. All right, Jeff's question. So when we take money from our liquid assets, how is that bucket replenished all at once or over months? Ooh, really good question. It's specific to what's going on in the market. It's specific to your tax situation. So an example might be that a client has said, look, we don't want to sell any more assets. And I'll use this as my segue to talk about tax loss harvesting. We don't want to sell any more assets in our investment account because we don't want to recognize any more gains for the year. We're trying to keep our tax bracket within a certain range, right? Well, that might place a constraint on how we choose to refill the cash bucket, right? So the long answer to your question, which is a really good one, is we do have a systematic way of doing it. We reconstitute our factor strategy. So we're essentially looking at the equities and the investments that our clients should be holding in their accounts every month. And then if it's a retirement account, we're rebalancing it every quarter. If it's a taxable account, we're doing rebalancing and aligning of the portfolio based on their tax situation. And then at least once a year, we're reallocating across the different tranches of assets. Sometimes it happens multiple times a year based on our client spending or their tax situation, but at least once a year, we're resetting how their assets are allocated across the market. Rick has a great question / statement. Schwab's paying 4% in the money market. Why should I change? Great question. There are financial instruments like money market funds, treasury bills, CDs that likely are paying a slightly higher interest rate than cash. But make no mistake, money markets are not cash in a bank account. So there's no FDIC insurance on them, generally, number one. Number two, they're a financial instrument that's backed by the underlying assets that that mutual fund, the money market fund, holds. So if you think back to 2008, and even if we look at other times in history when we've had significant market volatility, savings and loan crisis, et cetera, you can go Google, what does it mean to break the dollar, right? The there is a possibility. There's a lot of possibilities in the world. I'm not going to put a probability on it because it's probably a very low probability. But when you own a money market fund, the fund has the ability to not give you dollar for dollar your money back contractually. Okay? So there is a risk that if the underlying assets of the money market fund, which typically are swaps, short-term US Treasury bills, right? Short-term CDs, depending on how the money market fund's structured, there is a risk if the financial markets take a significant dive or there is a run on the bank, that the money market funds might have to break the buck and not return dollar for dollar on a money market. So a money market is fairly liquid, but it's not cash. So we would go cash, a guaranteed CD, US Treasuries, money market, right? And that's kind of like moving up the spectrum, let's say, of risk. So if you're perfectly comfortable holding a money market, and we have a lot of clients that we do hold money in money market funds for, right? It's not a bad thing. And please don't hear me like I'm not suggesting to that they're a high risk thing. We have a lot of clients that use money markets. Rick, I'm not fully sure what your question is. The question is, why don't you make it easier for your clients to rebalance the quarterly changes in your portfolio? This is if we just follow your portfolio and not have you manage it. I think I understand how to answer this, but you could add some more clarity to it. The reality is Lifeworks isn't publishing our investment strategies. We're not some kind of like investing newsletter or club where we say like, you know, here's the 50 equities you should hold. We're not a Jim Cramer or, you know, Motley Fool or something like this. So if we publish an investment recommendation that says, here's the equities you should hold, because of how we are registered as a fiduciary, as a registered investment advisor, we would be liable as providing you with investment advice. So when we're managing investments for our clients, we take that very, very seriously. We have criminal and civil liability for that. We have criminal and civil liability for that. So when we're rebalancing and we're managing our clients' assets, and the way, again, we do that is by matching their financial plan to their investment strategy, we're taking on the responsibility that our team is executing that in a way that's appropriate for you. Right? That's partly why we charge a fee for managing investments and doing financial planning services. If a client just wanted to say, hey, I just want to manage my own money and I want to follow your recommendations, well, for us to give you a recommendation of what to buy, we would still be giving you investment advice, right? But we wouldn't be taking any control, and we wouldn't have any control over how that was executed or how it was done or tax outcomes or things like that. So we're not publishing our factor holdings in such a way that a client could follow along. That's just not something we do. So if you're trying to mimic, it's probably never gonna be perfect, and there's things that you'll be missing if you're trying to just kind of like, hey, Lifeworks is managing some of my money and I'm managing some of my money and I'm trying to copy along. Like that's really not something we're trying to solve for. So I hope that answers that question. If you want like more follow-up, feel free to throw it in there. Okay, really good question so far. I hope this is interesting, informative. Let's talk a little bit about tax loss harvesting and direct indexing. I'm going to put the two of them together. So direct indexing is the idea that if we take something like I'll share my screen and I'm going to write some notes. I think I can illustrate this with my chicken scratchings here. All right. I will do my best to make my hieroglyphics readable. Okay, Rick, I see your thing. I'll maybe come back to it here in just a second. Okay, so let's talk about direct indexing. Okay, so the S&P 500 is the 500 largest market cap US stocks. So these are the 500 largest publicly traded stocks in the United States, okay? Every now and then names get added to it. Every now and then names get taken off of it. But when you hear the S&P 500, or when you hear the Dow Jones, right? This is the 30. NASDAQ, whoops. Sorry for my chicken scratchings, right? When we hear things like this, these are different indexes that track a certain basket of stocks in the equity market, okay? So what direct indexing is, we can own the S&P 500 by buying one ETF. A very common one that we use regularly is SPY, okay? That is an ETF, which is an exchange traded fund. So it's a financial instrument that owns all the stocks in the S&P 500 underneath it, okay? Very efficient way to invest in the market. Like whatever the S&P 500's rate of return is, if you own SPY, you basically get that return. And we do that for our clients. We use this in some of our portfolios. The challenge here is, let's say of the 500 stocks, right, at any given point in time, well, let's just say this, let's say 250 of them are up for the year, and 250 of them, the value of those stocks are down for the year. And this is just illustrative, folks. This isn't saying what the current market is. So withhold any bricks or stones that you might throw my way for this. I just want to make this illustration easy to understand direct indexing, and then to talk about tax loss harvesting, okay? So when we talk about direct indexing, what we're saying is, instead of owning one ETF, right? So instead of owning SPY, we actually want to own 500 individual stocks. Now the goal is to own these 500 individual stocks in the same percentage as the S&P 500 has them allocated. So if Apple is the largest company in the S&P 500, or Tesla at any given point in time, like whatever percentage that stock represents of the index, we want to own that many of that stock, okay? So direct indexing is fairly difficult to do for an individual. There is technology out there now that does it for individuals and for financial firms like ours, but it's made a little bit more difficult. And then at the traditional custodians, we have to buy whole shares, okay? So if somebody has $1 million account, we should be able to buy all 500 of the equities in the S&P 500. Okay, but what about somebody with a $450,000 account? What about somebody with a $50,000 account? So first challenge here on the direct indexing side is just that we have to have large account balances in order to direct index with traditional custodians. Now, why would we want a direct index? A couple of reasons. Number one, I'm just going to put why, or we'll say the pros. Okay, number one, tax loss harvesting. What is tax loss harvesting? Well, tax loss harvesting would say, let's say we have two stocks, stock one, and we buy it at $100. And let's say we have stock number two, and we bought that one at $100. But today, stock number two is trading at $50. Well, if we sell stock number two and buy more of stock number one, we're going to get to recognize a $50 loss on that sale. Okay, now let's say stock number one actually goes up in value to $150 a share, right? if we wouldn't have sold stock number 2 and recognized or capitalized on that loss, we would have a $50 gain on stock number 1. But because we've sold stock number 2 for a $50 loss, we're actually going to have in this portfolio 0 gain if we sell stock number 1 for $150. Folks, this is just a way of recognizing losses and gains on paper that create tax advantages for you. Now, there are a lot of investment firms, wealth management firms around the country that do tax loss harvesting. Typically, they reserve it for their premier clients or their very large accounts. Our goal at Lifeworks is to bring ultra high net worth level of services to everybody, regardless of their account size. We don't believe that somebody with $500,000 in their account should have less access to things that are beneficial than somebody with $5 million in their account. That's a philosophical belief that I have as the CEO that I've driven into our organization. So tax loss harvesting is intentionally not timing the market, not saying, we think Trump bad man going to do X, right? Or, oh, we love Trump. We think tariffs are going to make America great again. Buy these stocks. Okay, so this isn't me being political here, but this is the kind of news that gets fed to us, right? The people pontificating on news channels and the CNBCs of the world, like, because this is happening over here, we think we should go buy this over here. That's not what tax loss harvesting is. Tax loss harvesting done correctly is actually saying, we want to own these equities or these financial stocks, right? We're not buying or selling them because of things that we believe are happening in the market or not happening. We're doing it to recognize tax savings. So if I sell stock number 2 and I recognize a $50 loss, but then I sell stock number 1 and I make $50, right? The net outcome is I still have a $200 portfolio, right? But when you go to file your tax returns, we get this little thing from the custodian, your 1099 statement. And the 1099 is going to say that you recognize $50 of losses, and that's going to reduce any capital gains that you might have. Okay? So this is real. And we've known for a long time that doing tax loss harvesting systematically actually adds a pretty significant amount of value to our client's portfolio. Now you're saying, Ron, why am I talking about this as it relates to direct indexing? Well, here's why. If we only own the S&P 500 and we do it by holding one ETF, we can't tax loss harvest in that account unless the entire S&P 500 goes down. In general, on a long enough time horizon, the US equity market has been up and to the right, meaning positive rates of return. And there are periods of times where the market as a whole has taken a dip, but it's much harder to try and tax loss harvest with ETFs that own an entire index than it is to say, well, if I buy all 500 stocks, I now have 500 of these types of scenarios down here, where some of the stocks are going to be up, some of the stocks are going to be down on any given day, and we can sell the down stocks. There are rules to this, by the way. Our system follows the rules, so we don't run afoul of the IRS. We can sell the stocks for a loss, and we can reinvest those in the stocks that have gains, and we can create tax losses for you without your portfolio value changing. So direct indexing is probably the number one benefit, is that it gives us more opportunity to be strategic with our trading for tax purposes. If you're 35 years old on here and all you have is a 401k and IRA, like tax loss harvesting means nothing yet. Probably will at some point in time. What's another reason though that direct indexing might be the right thing to do? Well, number two is choice and control. Right now, if you invest in the S&P 500, 40% of the S&P 500 is made up from like 7 or 8 stocks. Apple, Google, Nvidia, Tesla, Meta. That's 6. Man, I'm missing the last one. Okay, you get the point. It's all tech companies, right? So if you own the S&P 500 right now, if you own just SPY, you essentially have an overconcentration in tech stocks. Now, the last decade, the majority of the rate of return of the S&P 500 has been driven by big tech. And everybody has looked like a genius by, oh, it was Amazon. How did I forget Amazon? Right? Everybody's looked like a genius, right? Everybody's like, oh man, my portfolio, blah, 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 blah. When you zoom out on a long enough timeline, every point in history of the US equities market has had times where different industries or sectors have dominated, and everybody's essentially crowded into those stocks. We don't know when those growths of those tech companies might slow. We don't know when they might go out of favor and be sold off, but we are very cognizant. I talked about this 2 videos ago of the concentration risk of owning just SPY. In fact, it was one of the reasons I talked about why we use factor investing. But similar to that choice and control when we're doing direct indexing, it might allow us to say, look, of the 500 largest companies, I want to own all 500 of them. I just want to weight my portfolio differently. I want to use equal weighting. So I don't want to have overexposure to tech. Or you might be, we're in Michigan here, so the home of the auto industry. Maybe you have a bunch of stock in companies that serve the auto industry, and you're like, hey, I want to own the S&P 500, or I want to invest in the US large cap equities, but I don't want to have exposure to the auto industry. When we direct index, it gives us some choice and control for filtering. Okay. Altruist lets us, they created the technology, and they're not the only one, but they're one of the pioneers of what we call fractional share investing. So at Altruist, we can do fractional shares. I see a question about dividend reinvesting. I will get to that. It's a good question. Okay, fractional shares. Well, normally, if a share is trading, so we're going to say stock number 1. Let's say stock number 1 is trading for $100, right? Well, let's say that this investment account is $150. I know this is a hypothetical example. Put 3 more zeros in it, scale it to $1 million, $1.5 million, you'll start to track with it here, right? If this person has $150 in their account value, they can buy 1 share and they'll have $50 left over. Just to make sure everybody hasn't fallen asleep on me, give me a Giphy or some kind of reaction to make sure everybody's tracking, understands my hieroglyphics here. Okay, well, what if I wanted to get that $50 invested in that stock still? So what we can do with Altruist is we can actually own fractional shares to the 5th decimal point, 0.00001. The same decimal point that most banks are paying interest rate at, 0.0 nothing. Right? In this example, what it would mean is that our client, you, would actually be able to buy 1.5 shares, and we could be more efficient with the cash. Why do we want to be more efficient with your cash? Good question. Here's a simple example. Over a long period of time, cash rate of return has been around 3%. Does anybody want to throw out a number in the chat for what the US S&P 500s, let's say 10, 20, 30 years, give me one of those, like, what do you think the average rate of return's been over a longer period of time in the S&P 500? It's not, I'm not going to hold you against it if you're off some. So we got 10, 12%. Yeah, let's say that S&P rate of return on a long time period has been 10%. This will just make it easier for me to do math, okay? Neil, 8% doesn't matter. Do this math in your head with me. It doesn't take a SpaceX engineer to realize that if we buy 1 share and we have $50 of cash left over and our cash is earning 3%, or we can invest all of our cash in the equity, which is the thing we're trying to accomplish because we're going for long-term growth. If the equity has this amount of upside and the cash has this amount of upside, we want to try and be as efficient in the deployment of our cash when we're buying securities as possible. And this is not generally a problem that most advisors talk about with their clients. I think this might be the first time in 8 years that I've talked about this kind of very technical in the weeds piece, but it's really, really important actually. I probably should have been talking about it sooner. We've always tried to be extremely efficient with our clients when we're investing for them, like extremely efficient, where we have, if we are going to have some cash left over, we try and find a money market fund or a US Treasury fund or something that's going to earn better than 0.0 nothing rate of return. But now with fractional shares, which we can do with Altruist as our custodian, we could also do it with Apex, right? That's one of our current custodians. We have the ability to be way more precise and have less what's called cash drag on the portfolio. So direct indexing and tax loss harvesting are two key features that we're going to make sure every one of our clients at Lifeworks has access to where appropriate, right? But they are very beneficial. I want to show a screen here. Let's share. I'm going to change my screen. And I'm going to take a sip of my dandelion root beverage here. See if I can do two things at once. Okay, got it. Delicious. Okay. This might feel like a sales pitch for Altruist. It's not. We really thought it was important as a team to walk through this collectively with you guys. So this is a back test done by Altruist investment team to look at the impact of tax loss harvesting, or what they would call active tax management. This is not an investment recommendation, okay? This is not saying this is for everybody, but one of the things we asked them to do was to actually provide us with a document that we can use to help explain the benefits of long-term active tax management for our clients. We've been doing it, but with Altruist now we have the ability to use their advanced algorithms, AI, and essentially the way we look at it is this 24/7 autopilot technology that's making sure we don't miss tax loss harvesting opportunities, right? So think of it like autopilot. Okay, so this is a $1 million account that they put regular deposits into each quarter, right? To establish different tax lot bases, meaning they're not just starting at $1 million, they're putting in 50 grand every quarter and building the account up to $1 million, because that's probably more realistic to where most people's accounts are, right? Most of our clients build their investment accounts over time, not just all at once. Some people all at once sold a business or something, right? Target was a 1% cash balance with a little bit of a drift tolerance to it. Now, for those of us that don't live in the great tax state of California, you might be thinking, this isn't as big of a deal. I don't have to pay California's tax rate. That's true. Capital gains rates for most of us in states that have state income tax generally range between 15 to 25%. So long-term capital gains tax rates for a lot of our clients are around 20%. And then if you're in a state like Michigan, where I'm at, our state income tax is 4.25%. So my capital gains rate would be 24%. So this is just an example, right? Altruist is based in California, so they use their tax rate. Okay. Over a 5-year period of time that they did this, and they didn't cherry pick the time, they just went back and did this for 5 years just to make this illustrative to help our clients see what the actual impact of having a smart active tax strategy was for their investment account. So the non-tax managed account ended this hypothetical scenario with 3.4 million. The tax managed account had 3.59. That's a 1.4% difference in the rate of return over that 5-year time period. Now, what I want you to think about is the average time frame for somebody's retirement is 20 plus years. So the impact on this over somebody's lifetime or over somebody's retirement is significantly greater than this 5-year window. But I didn't want them to build this with a 20-year time frame and then have somebody come back and say, well, yeah, that's looking at 20 years. What about over the next 3 or 5, right? So we did a shorter time frame, right? Which you could then say, well, this benefit obviously compounds over time if it's done, right? So I'll pause on this one here, jump back to some questions because I didn't want to get too far into the weeds about this. I just wanted to show some illustrative examples. And what this assumes, right, is that if we're not tax managing the account, right, we're missing out on capturing losses that help offset our gains. The takeaway is the account still had a great rate of return. The market's been phenomenal for just about everybody for the last 5 years. But it can be incrementally better. A smart, active tax management strategy for most of our clients, and we've done this work and we've done this math and we've been doing this research with them, will more than likely pay for the fees that you're paying us as your investment advisor. And we just think, again, our goal is to drive better outcomes for our clients, to put in place the systems and the technology and the right tools that it might only be a marginally improved outcome day one, but over time that outcome grows and it becomes significant, right? So there's obviously no guarantee market could completely kaput tomorrow, but over a long period of time, wherever the market goes up and down, if we're capturing the appropriate tax loss harvesting along the way, it's real money back in our clients' pockets. It's real money back in your investment portfolio. Okay, so I've covered a lot. I'm going to do a quick recap. I'm going to catch my breath. I'm going to ask some questions. I'll let you ask some questions. We're at 4 o'clock. I do have a couple questions here to still cover, so feel free to throw some more. I wanted to cover one more thing about portfolio hedging that we do for our clients. And we have a new partnership that we put in place this year with BlackRock to just really make this an even more powerful benefit. So I'm going to cover that next year. But if anybody has any questions specifically, we've covered how we're registered, why we use custodians. We've obviously been talking a bit about our newest custodian, Altruist, the differences in just something as simple as cash management, right, on a long enough timeline, big number. Altruist does fractional shares, which makes it so that doing direct indexing becomes affordable and easy access for any client, regardless of their account size. And then for those that have a taxable investment account, our ability with Altruist, we have another partner we do this with too called Ethic, but our ability with Altruist to run very sophisticated portfolio management software that can capture losses using our factor strategies or using direct indexing is just a really powerful advantage that we're putting in place. All right, so John and Shara, I'm going to take your question first, and then I'll jump down to John D and take yours. John's question, if I sign up for DRIP, which is Dividend Reinvestment Program, in an ETF, could I not use tax loss harvesting by strategically selling those lots that have lost to offset those that are gained? Absolutely. An ETF trades just like a stock. And so if your ETF is down in value and you sell it, you can capture a loss. There's a 30-day window of time that you can't go back and buy the same ETF. It's called the 30-day wash rule, right? But theoretically you could, and we do that. We have clients that we've done tax loss harvesting on their ETFs. If an ETF holds 25 stocks or 50 stocks or 500 stocks, though, the ability to capitalize on tax loss harvesting through direct indexing is a lot greater. That's the point. The point isn't like, should we not own the ETF? Like, it might still be right to own the ETF, but our ability to generate additional alpha from tax loss harvesting when we own the underlying stocks that be in that ETF are better. Okay, John D. Ron, could you elaborate some more on what services Lifeworks provides are covered by the management fee? For example, tax planning, preparation of returns, wills, trusts, etc. Are there other services that would be considered a la carte? Really great question. Okay, here's a simple way to think about it. When we set up Lifeworks, summer of 2017, one of the very first theses of our business plan, one of the very first things we wanted to accomplish for our clients was we wanted to bring a different business model to the market. 96 cents of every dollar of revenue in our industry, or fairly close to this, comes from an advisor or a financial firm charging an assets under management fee. Okay, I'm not saying there's anything wrong with that, I'm just stating fact. But we consistently had clients that when we would ask them, do you have a clear, well thought out written plan for how you're going to navigate retirement? They would go, I have some charts and spreadsheets. And I'm like, okay, that's not a plan. Like, do you have something that says, here's what's most important to you, here's how you want to live your life, here's how you're going to navigate? And they're like, no. Like, okay, do you have a financial advisor? The majority of the time people would say yes. And the third question became the very clear disconnect. Well, do you know what you're paying your advisor, and what are you actually paying them to do? Are you paying them to help you with financial planning and advice, or are you paying them to manage your money, right? Or some combination. And what we found, and what we believe then and what we believe now, is that people should have access to really personalized, fiduciary level financial advice and financial planning without having to move their assets to the firm. So at Lifeworks, we have two services that we offer our clients and two distinct fee structures. Our membership fee, which covers financial planning, and there's 8 areas of our membership. So we have family strategy, which is values, vision, goals. We have financial planning, which is math models, charts, tax projections, things like this. We have risk management, not just life insurance, disability insurance, but how are we managing asset protection, right? Do we have enough umbrella insurance in place? Tax planning, we do have strategic partnerships with CPA firms that provide tax preparation services for our clients. Business planning, investment strategy, estate planning, and charitable giving, or what we would call legacy philanthropy. Those are the 8 broad areas that our membership fee covers, okay? So if you're a member of Lifeworks and you're paying our monthly membership fee, we're going to help you create a values and vision statement for what's most important to you and how you want to live. We're then going to translate that into financial projections, tax projections, et cetera. That's financial planning, okay? Not knowing your values and vision, it's impossible to actually build a financial plan that's of any validity. So we have somebody's financial plan, jump forward a few services. We will help the client, you, understand how their assets should be allocated based on their financial plan. Meaning, we'll say, okay, you need to have $100,000 in your emergency fund in cash. You should have $500,000 in tranche 2, low volatility, safer types of things. And then the rest of your money should be invested for the long-term growth. That's really an asset allocation recommendation. If somebody then says, well, I'd like Lifeworks to help me manage my money, meaning help me decide what to buy, when to sell, how to tax loss harvest, what my custodian, making decisions about the the managing of the money, that's what we charge our 80 basis point fee for. Now, your fee structure might be slightly different. We give our advisors some flexibility to help our clients meet them where they're at. So some people pay a slightly higher asset management fee, but then they're not paying our monthly member fee. Some people are paying our membership fee or a higher fee for planning services and then a lower asset management fee. So it's not perfect across the board. We are bringing everything together as much as we can and trying to unify it because we believe it's the right approach. So John, long answer to your question, and I hope this is helpful for everybody just to be reminded of and understand. We view financial planning and family strategy as a distinct service from asset management. When we take responsibility for managing our clients' assets, right, the custodial selection, the cash recommendations, how we're trading, cash efficiencies with trading drag, right, taxes, so there's a lot of things that we take into account there, and there's a lot of really great services that our team provides, and we charge a fee for that. So if you're a client of Lifeworks, you have access to estate planning, tax preparation, financial planning, family strategy, risk management, probably, and I don't say this bragging, but I believe one of the best, if not the best investment platform for clients because of how we approach all the little thoughtful things about maximizing our clients' cash return, minimizing fees, putting the right custodians in place, bringing the right partners to the table to hedge downside risk where appropriate and things like that. So hopefully that answers your question. I would say if you have specific things that you're like, does LifeWorks provide X, Y, and Z? You can feel free to like throw it in the chat or shoot an email real quick to your advisor, and they should be able to walk you through a more specific list of services we cover or don't cover. Noel's question, will Altruist have the ability to use options or hedging in the future? Yes, it's coming very soon. I don't have, that is the one downside to Altruist, is they don't provide options right now. They do have margin, they have securities-based lending, they have a lot of those things that have to be built before a firm can tackle options, but their CEO and their executive leadership team, who our team interfaces with pretty regularly, has options at the top of their roadmap. I would expect them sometime early to Q2 of next year. All right, great. Any more questions? I was going to cover one more topic. I know we're already an hour and 10 minutes into you all listening to me talk. Hopefully everybody's still awake. All right, everybody ready for me to move on to our last topic of the day, which will be portfolio hedging. Give me a Giphy thumbs up. Somebody bring back that French Bulldog and Bernie Sanders for me. There it is. I think that's what that looks like, I think. Okay. Last dry but important topic of the day, one that gets misunderstood by many, many people. And interestingly enough, the area of the stockbroker exam, the Series 7, that generally creates the most failures for people passing, that is the section on options. There is a lot of misunderstanding about options and hedging instruments. So we're going to talk about this, and I'm going to put it in some context of why LifeWorks uses hedging. This is not meant to be Ron pontificating that I think the market's overvalued and everybody should rush out tomorrow and call your advisor and ask for hedging. So for any of my advisors listening to this too, nobody panic, right? This isn't a race to like hedge our bets. But LifeWorks does believe that there is a role, a very strategic and important role, that hedging can play in helping you achieve more consistent returns in your portfolio and manage some of the risks that you face. One of these risks, right, is that if we don't have any hedging in place and our portfolio needs to be spending money, right? Before LifeWorks came along and built some of the things we built for our clients, most of our clients, were being sold annuities or some type of insurance product that had some kind of like guarantee to it, right? And we just felt most of those are expensive. They have surrender charges. They tie people's money up. Sometimes they're not super tax efficient. And so we looked and said, look, if we could own the same equities that we want to hold for the long term, but just say, look, we need to put some downside protection in place that if 0809 happens again, or 2022 or 2000, 2001, like we don't get caught from this black swan event and be forced to spend money out of our portfolio that's now down 20, 30, 40, 50%. Okay. So I'm going to walk through a sample proposal from one of our strategic partners. This company is called Spider Rock Advisors. They are owned by BlackRock. If you don't know who BlackRock as a company is, there is a lot of things out there on the internet, bad and good, but BlackRock's the world's largest asset manager by size. By definition, there is a lot of things out there that I think are kind of erroneous about them. Their CEO, part of the Davos crowd, plotting to, one world governments take over the world. Like, there's a lot of this stuff out there. And again, I'm not getting political. Just if you go Google it and you find yourself down a rabbit hole on the internet, just know that like BlackRock is the world's largest asset manager. Probably isn't most of the things that you might find on some of those sites or Reddit threads. Okay, let's just walk through an example of why LifeWorks would use this and what it would mean, what it looks like. Okay, lots going on here. let's start with the basics. I asked them to simulate a $1 million portfolio. I used $1 million because for a knuckle dragger like me, it makes it easy for me to do math, okay? This is not a specific investment recommendation. This is not a specific client account, okay? And what I wanted to do is I wanted to say that we're going to use SPY as the underlying investment strategy. So SPY is the world's most traded financial instrument. It's an ETF that tracks the S&P 500. So what I want you to think about when you see this is an example of how we would create downside protection, meaning we would create a floor on a client's portfolio that's invested in the S&P 500 or some kind of proxy like that, okay? So what I asked them for was I said, I want a 15% downside target. So the portfolio's beta meaning its relational movement to the S&P 500, is 855,000. So I'm saying, look, I want a floor that's around 15% below my $1 million starting value. So 1 million minus 15% is about 850. Everybody tracking? I'm only going through this way because there's a lot going on in this slide. I want to make sure everybody's tracking with me. Give me a thumbs up. Give me the French Bulldog again if everybody's tracking with me. Okay, one of you, two of you. Okay, we're going to get a passing grade here before too long. Okay, ignore a couple of things here, right? And I'm going to point out a couple of things. One, SpiderRock charges our clients 50 basis points for this. There's no such thing as a free lunch. SpiderRock is probably one of the largest options trading and hedging companies in the world. In fact, they do just an enormous amount of this, and they have amazing technology. So this is an actively managed hedged equity strategy, okay? Meaning their team is buying and selling options, right, to keep this portfolio inside of what we've said the tolerance for downside protection should be. So we set the mandate, working with you, our client, that we want to have, say a 15% downside floor, right? They go out there and they're buying puts on the S&P 500, right? So when we buy a put, it gives us the right to sell at a certain value. That creates this green line here, okay? So the black line that goes up and to the right is mapping the return or the hypothetical returns of the market of SPY. The green line is tracking the possible outcomes of this portfolio with the hedging in place. So what it's saying is if we own the S&P 500, and we can come down to this table down here at the bottom, okay? If the market goes down 40%, the portfolio return, the S&P 500, would probably be down around 31%, and our portfolio would be down 7.17. So the area below this green line, I'm wondering if there's like a pointer in here. Whoops, doesn't look like I have a pointer I can use. The area below this green line is all the downside that we've protected against. Portfolio can't go below a certain value, okay? Now, conversely, if the S&P 500 goes up 40%, this portfolio is projected to have a 37, well, the S&P 500 is projected to have a 37% rate of return after fees, but the hedged equity portfolio is only going to have a 12.7%. Why? Well, to pay for our downside protection, the puts that we purchased, in this example, they also sold calls. That's what this C here stands for. They sold a call, which means if the market goes up past the call strike price, this portfolio gets called away and we essentially lock in our gains. Okay, a lot going on here. Where would we use this at Lifeworks and why would we use this? Remember how I said we allocate our clients' assets based on when they have to spend the money. So tranche one, which is the next 3 years of somebody's cash flow needs, We believe that should be in cash, CDs, money market funds, US Treasuries, something like that, okay? Tranche 2, we call that our income tranche, right? That covers year 4 through year 10. It's a 7-year period of time. Previous to 2022, we were, for the most part, holding hedged equities for our clients because interest rates on US Treasuries and fixed income bonds was virtually nothing, okay? So it made no sense in our mind to hold a 5 or 10-year US Treasury that was paying like 0.5% when inflation was 2.5 or 3. So we were owning equities, but then we were hedging them to take away a significant amount of the downside risk and the volatility. So one of the things that you could say is the difference between the green line in the top right-hand quadrant and the green line in the bottom left-hand quadrant, this space in between, is the amount of volatility that the portfolio can have. We've eliminated like 80% of the volatility of this possible portfolio. Now, why would we do that? Well, for us and how we manage money for our clients, we believe it's more important to match the right type of asset with the right volatility metric to when the money needs to be spent. But this gives us the ability to have higher upside than just owning US Treasuries or some kind of fixed income instrument. There's no such thing as free lunch. There's a fee to BlackRock to do this. And then there is also a fee to buy the puts. Now, in this strategy, which is something similar to what we used to use as well when we were managing these before we partnered with BlackRock, in this strategy, we're both buying puts, which cost something, and we're selling calls, which means we're collecting some premium. So right now, if we were to have done this today, if we were to have bought downside protection, and we were also to have sold away some of the upside by selling a call, we would have actually made about $1,000. The difference between the premium collected and the premium we paid. Premium is what you either earn in income from selling an option or what you pay to buy one. Now, if you, your family, your friends, your colleagues have a concentrated stock position, right? Let's say you worked for eBay or Apple or Google or Ford, and part of your retirement over the years or part of your financial holdings is that you were paid in company stock. We see this all the time. Clients will show up and they'll have $3 million saved for retirement and $1 million of it will be in 1 or 2 stocks, right? But a very common one actually is somebody that bought Amazon or Apple or some collection of tech stocks 5 years ago or 10 years ago. And now they're like, hey, I bought these for 100 grand and now it's worth $1 million. I don't want to sell these all today because of all the capital gains, but I also feel like I have a lot of risk in just a couple stocks. Like, what do I do? We can apply this same structure to a concentrated stock position without having to sell the stock position. This is really, really important. So I know we do this for clients now, so you might be like, yep, check, my advisors are doing that for me. You might be going, hey, I'm new here. I'm just starting to work with your advisors. I have a concentrated stock position. This is a way we can minimize the risk that that concentrated stock has a significant downward movement or adverse event, which might cost you a lifestyle change or some kind of negative event for you on the personal side. This is a way we can hedge or push off some of that risk and give ourselves more time to potentially be strategic, maybe about selling that concentrated position. And instead of having to sell it all at once or in big chunks, we can sell a little bit of it every year or something like this and have a better tax outcome. So Lifeworks uses hedging, not because we're trying to time the market, but we use hedging strategically for our clients to help them minimize risk from concentrated stock positions or minimize the volatility in a section of their investment portfolio. So we have a higher probability of being able to achieve the income that they need in retirement or a higher probability of being able to achieve some type of financial goal like saving for college, buying a house, something like that. So hedging is not grandmother's elixir. It shouldn't be used for an entire portfolio. It's not something we're saying everybody needs, but it is something that we've used historically for clients. It's something that not every wealth management firm offers their clients. We believe in it. And we've increased our capabilities this year with our strategic partnership with BlackRock and their subsidiary, SpiderRock. Okay. That's all the topics I wanted to cover today. We have 7 minutes left. I actually will plan to stay a little bit longer, answer questions. I'm going to kick on everybody's ability to put your mic on if you'd like to ask a question or give a comment verbally instead of chatting it in. I just made it so everybody should have access to turn your mic on. Menu bar in the bottom is your mic. If you want to kick your mic on and ask me a question, love to chat with you. Feel free to also put them in the chat if you're there. If you have to jump, just know from me and everybody at Lifeworks Advisors, we absolutely love and we are honored that we get to serve you and your family, and we're hoping we get to do it across multiple generations. We take our role as fiduciaries and stewards very importantly. And our promise to you is to help you make meaning out of your money and live an intentional life. We're constantly looking for how can we increase the probability and minimize the risk so that you can live intentionally and live the life you want. So if you have to sign off, just know we are grateful that you're a client. We love serving you. Look forward to having you in another one of our live streams. If you want to kick your mic on and ask questions, I'll stick around for another, let's say 15, 20 minutes, answering as many questions as I can in that time before I have to get out of here for kids' soccer practice. Jeff, you're absolutely welcome. I really appreciate everybody sticking around this long, listening to me talk for an hour and a half. As my kids would say, is maybe not the most fun thing to do in life. So I appreciate you guys sticking around and paying attention and asking good questions. Neil, you are absolutely welcome. John and Shar, we love having you guys as clients. Thanks for being on here. All right, well, it looks like the questions have dried up. So we'll end our live stream here now. Once again, from everybody at Lifeworks, I'm Ron Bullis, the co-founder and CEO. We absolutely love and we are honored that we get to serve you and your families. Do not hesitate to reach out to your advisor, and we are very excited about the addition of Altruist as a custodian, our partnership with BlackRock. We are not going to stop. We're going to keep working on bringing new innovations and better outcomes for our clients. So stay prepared to hear from your advisor in the coming weeks about what this will mean for you, your investments, and your opportunities going forward. Thank you all. God bless. Have a great rest of your week.